My name is Sarah Slade and I'm the Head of Digital Engagement and Collection Services here at the State Library. It gives me great pleasure to welcome you all to the policy pitch tonight. This seminar is held on the traditional lands of the Kulin Nation and I wish to acknowledge them as the traditional owners. I would also like to pay my respects to their elders and to the elders of other communities who may be here this evening. I'd like to give a warm welcome to tonight's speakers, Ricky Polygenis, Gwei Lim, and our moderator, Dr. Jim Minifie. I'd also like to welcome Grattan Institute members and staff and friends of the library who may be here tonight. We're delighted to present the Policy Pitch series in partnership with Grattan Institute. This seminar brings together 3 leading Australian economists for a discussion about the low growth problem and Australia's prospects and policy priorities. Uncertainty in Australia's economy and seismic shifts in workplace skill requirements mean a smart and adaptable workforce will be needed to ensure a solid position in the global economy. To that end, libraries will be among our most valuable public resources. Libraries allow free and open self-directed learning in a supported and resource-rich environment, which is a potent combination for rapid and diverse skills development. So part of preparing for the future is to have some insight into what it may look like. And Ricky, Gwei and Jim will give us some of those insights tonight. What should Australia do to avoid the slow growth trap? I'm looking forward to hearing their answers. So I'm pleased now to introduce Jim Minifie, tonight's moderator, who will introduce the panel and lead the discussion. Jim is the Productivity Growth Program Director at Grattan Institute. He's a leading economist and writer with a strong grasp of the Australian policy landscape. His research focuses on developing policy to raise Australians' living standards by improving productivity and accelerating the spread of innovations. Please join me in welcoming Jim.
Sarah, thanks so much and good evening everybody. It's really my pleasure to introduce our 2 speakers. Our format for the night is that Ricky and Gwei are going to make brief presentations and then we'll break for a discussion. We've got plenty of time at the end for questions. And I just wanted to start, Ricky, by introducing you. I've known Ricky for a long time. She's the head of Australian economics at the National Australia Bank. Prior to that, she was at the ANZ for many years, and prior to that, the Reserve Bank. And Ricky's a very well recognised commentator on some of the topics that we're going to cover tonight. And just quickly, let me also introduce Gwei Lim. So Gwei is at the Melbourne Institute at Melbourne University. She's a professor, effectively, of macroeconomics there. Your research covers a huge range of topics, everything from macroprudential issues, labour markets, macro modelling and forecasting and so forth. And so I can't think of 2 better people to introduce the topics we're going to talk about tonight. Without further ado, if I could invite you up, Ricky, for your brief presentation. Thank you.
Good evening. Thank you. Dynamism or descent, a huge topic at a time in which structural and cyclical forces are colliding, both locally and internationally. My opening remarks today will look at Australia's economic performance since the global financial crisis and touch on some of the factors which helped us ride that wave, and referencing some of the key features which may or may not be at our disposal going forward. So first off, despite a lot of the talk of doom and gloom for the Australian economy in the press, which we hear every day, it is important to recognise that Australia's economic performance has actually been pretty good. So if you look at this chart here of real GDP growth rates, real GDP growth, it's indexed, I should say, but you can see there that since 2006, the Australian economy's grown by more than 30%, or an average of about 3% a year, which is just below its historical average growth rate of 3.25%. By contrast, many other large and advanced economies have grown by a much reduced rate. So the US has grown by approximately 15%. It did suffer a recession through the global financial crisis and has recovered, but the Eurozone and Japan have expanded by just 10% and 5% respectively. And our latest national accounts figures for the June quarter showed the economy was growing at about 3.3%. So then what of all this talk of income recession that you might have heard about? Well, that's because real GDP has been growing at a different rate to measures of national income. So here on this chart you can see real GDP growth in the grey, but the red line there is real net national disposable income per capita. And that adjusts for the terms of trade effect, so the significant increase and decrease we've seen in commodity prices in particular, as well as foreign income and a few other things. And you can see that that has actually been going backwards for 11 out of the past 12 quarters, although there was some bounce in the latest data. But, you know, a lot of that decline was because the boom that we saw in commodity prices has now unwound. Globally, there's been a pickup in commodity supply at the same time as global commodity demand has come off. So to some degree, that was inevitable. In my view, I like to call that the income recession that we had to have, channeling Paul Keating. So returning now to what helped us get through the GFC, we can see here that a lot of that was to do with the surge in mining investment, which in turn was in thanks at least part to the Chinese government and their stimulus efforts in the aftermath of the GFC, because commodity demand really did surge at that time. So mining investment went from around 2% of GDP in the early 2000s to a peak of 9% of GDP in 2012 and 2013, and it's now come off to around 3.7% of GDP. It's about 70% of the way through the adjustment back down to where we think it'll settle at about 1.5% to 2% of GDP. This increase in capital expenditure did to some degree come at the expense of investment in mining, in non-mining areas of the economy, and you can see there that non-mining investment has fallen as a share of GDP. It also led to an increase in Australia's capital to labour ratio, and to some degree more recently in our labour productivity as well, so output per unit or per hour worked as well, and that's because of this capital deepening or increase in investment. But the main point to make there is that this hasn't led to a rise in multi-factor productivity. So you may have seen that the Productivity Commission yesterday has put out a briefing paper asking for submissions around how we can improve Australia's growth prospects going forward, and they did highlight that multi-factor productivity has actually been stagnant since around 2004. So other things that have allowed the Australian economy to adjust include the exchange rate, and I won't go through all the numbers here, but you can see the dramatic rise in the Aussie dollar on the left-hand side there, which has mirrored to a large degree the rise and the fall in the terms of trade. You can see also on the right-hand side that interest rates have fallen, well, they rose at the height of the mining boom, but then have fallen since that time, helping the economy to adjust and allowing the non-mining sector to recover. But I guess a lot of that increase in the Aussie dollar did arguably lead to a hollowing out of Australia's industrial base, or what some people call the Dutch disease as well. So you can see here, this is a chart of the NAB, from the NAB survey. We put another update out today which actually showed a bit of a fall in business conditions, which we're watching quite closely at the moment. But the main point to make here is that between around 2010 and 2013, conditions were actually deeply negative in a number of industries, including construction, manufacturing, wholesale trade and retail as well. Now that has since improved as the Aussie dollar has depreciated, but in some industries like manufacturing, of course, that offshoring process can't really be reversed. The other way that the economy adjusted was through a relatively resilient but also flexible, some of you might find that controversial, labour market. What we saw actually was quite a large drop in hours worked at the height of the GFC, which hasn't been recovered. In actual fact, hours worked have dropped again over the past year. So average hours worked in September 2008 was 35.8 hours a week. That dropped to 35.2 hours a week in late 2009, and the most recent data shows that it's dropped to 34.8 hours. So while that did prevent a rise in unemployment, what we've seen through this period is a rise in the underutilisation rate, so particularly the underemployment rate. So that means the number of people who would like to work more hours. That's partly because the industry mix of growth is changing, and so we're seeing stronger growth in industry where there's a higher rate of casualisation, like health and hospitality. But that's not the full story, of course, because there are many other workers who would like to work more hours. So that suggests to us that there is still spare capacity in Australia's labour market. If you take those numbers forward, we don't forecast the underutilisation rate, but for the unemployment rate, we're expecting it to remain around where it is, in between around 5.5% and 5.75% over the next few years, which is still above where full employment is considered in Australia at around 5%. So that does suggest that we're not going to see much upward pressure on wages, and that's going to be a constraint on household incomes and therefore household consumption growth going forward. So in terms of the near-term outlook for GDP, our forecasts are pretty benign actually. We've got growth, or real GDP growth, of 3% in 2016 as a whole, followed by 2.8% in 2017 and 2.6% in 2018. By 2018, that's reversing to around where we now see Australia's potential growth rate of around 2.5%. At that time, we won't be getting as much contribution from net exports. So at the moment, these real GDP numbers are being inflated by the very strong contribution from mining exports following the mining investment boom, particularly at the moment in LNG. By 2018, we're also not going to have as much dwelling construction either, because we believe the dwelling construction cycle will have peaked, and we're getting moderate rates of household consumption growth and non-mining business investment growth at that point in time. And I should say also that I haven't shown forecasts of national income growth, but for the most part it will be growing pretty much in line with real GDP, except in 2017 where we're going to get a bit of a boost to income growth actually because of the recent surge in coking coal prices, which will probably be unwound by the time we get to 2018. So dynamism or descent, where do I stand on this issue? Well, I think it's neither really. So it looks to me more like a slow and hopefully steady grind. There are reasons to be optimistic. 25 years of uninterrupted economic growth hasn't happened by accident, and much of the flexibility exhibited by the economy still exists, and we still have a flexible exchange rate, a more flexible labour market. We have strong ties with emerging Asia, our connection through trade and also through people, strong migration, but also access and exposure to the rapidly countries where population growth will be very rapid, like in the Mekong Delta and India. Equally though, it is difficult to envisage a pickup in productivity growth or growth in the labour force, participation necessary to return Australia's potential rate of growth back to where it was in the past. So I mentioned earlier that we now see potential growth for Australia at about 2.5%. That's actually down from pre-GFC estimates of 3.25%. Our numbers are also a little bit weaker than where the Federal Treasury's estimate is at the moment. They're at 2.75%. And it is worth noting, actually, that they're expecting above potential growth in their budget estimates going forward, so above 3%. In terms of the composition of these figures, it's hard to see a much larger contribution from labour coming through because we have an ageing population who have a lower rate of participation in the labour market. There are some policies that we can do to help address or improve female participation in the labour market and the participation of older workers, which will be welcome, but there are still going to be limits on how much we can grow that component when you look at potential growth in this framework. Stronger productivity growth is the main area which we can affect, but to get the same rates of productivity growth we've seen in preceding decades, we really need to see the same pace of economic reform. And that's implicitly is what's being assumed when you see forecasts elsewhere. And that is going to be quite challenging because a lot of the reforms that need to take place now are more micro in nature, microeconomic reforms, or they involve politically challenging taxation reform and coordination across the states and territories. I am a bit more optimistic on the infrastructure front. I do believe that we can, there is a lot of private investor capital looking to invest in infrastructure at the moment because they want long-term safe investments, and in a global environment where very low yields are on offer, infrastructure projects do offer that for investors. And surely as an economy we can come up with some projects which have a higher rate of return to the economy or society than the current 30-year bond rate of 3.3%. So to me, that really needs to be an area of focus. But even still, you come up with numbers which are not terrible, but they are a little bit slower than what we've been used to in the past. And also the other point that needs to be made is that we do have less flexibility in terms of fiscal and monetary policy going forward. So the RBA cash rate is now at 1.5%, like in the chart that I showed you before. Its broad consensus is that 1% is around the floor for the cash rate in Australia as a small capital importing economy. Perhaps we could go down the path of a quantitative easing program or asset purchases or even helicopter money. But I think we would need to see a much more substantial slowdown than what's in our forecast for the RBA to go down that path. I think there's also less room to move on fiscal policy, as everyone is well aware. The budget's not expected to return to surplus until 2021, and it's a wafer-thin surplus at that. But in a crisis, we probably could see a bit more fiscal stimulus because public sector debt, general government debt, at least for the Commonwealth, is around 18% of GDP at the moment. That compares to the advanced economy average of around 75% of GDP. So while we might suffer a little bit on our AAA credit rating, the government does have some room to move in the event of a crisis, but it probably cannot justify further stimulus to the economy just to help rectify kind of below average rates of growth. So I will let some of the other speakers touch a bit more on the policy options at our disposal, but to me, the outlook is one in which is not terrible. It is positive, but it is where growth is a little bit lower than what we've become accustomed to, and income growth is also a little bit lower than what we've become accustomed to. Thank you very much.
Good evening. So I'd just like to make a few points before we begin our discussion and open it up to the general. Take general questions from the floor. Now, my first slide is to reinforce the point that Ricky has just made, namely that the rich world has stagnated, it's not growing, and that the IMF expects it to continue to experience slow growth. Now, if you look closely and carefully at that graph, what you see is that Australia isn't doing too badly. We are above the Western countries, US and Euro, But of course, our growth is below the Asian countries. Now, what's happening in China is that China is rebalancing. It's moving from a very high growth dependent on investment to a sort of a domestic economy reform. Sorry, let me state again. The government's adopting reforms to ensure that they have sustainable growth into the future. And that means they want to move away from high investment type growth to more consumption-led growth. All right. So Australia has escaped the recession, but we should expect it to growth to remain low for a very long time. The first point I want to make is that we can no longer rely on growth from external factors, external economy, to stimulate our growth. We're not going to get it from trade. If we're going to grow, it has to be homegrown. We'll have to find ways of growing our growth ourselves. Which then leads me to the questions about policy. So if we think about policies, we would traditionally think about monetary policy, fiscal policies, and the rest. Now, as Ricky has said, for monetary policy, we're kind of at a low level. And the reality is that if the government were to reduce the rate further, it's quite unclear that it will stimulate further spending. With which the point when perhaps what will happen is that any further reduction in the rate will lead to a house price asset bubble, rather than to genuine change in spending and growth and jobs. And Ricky has also touched on the constraints of fiscal policy, and I know we've read a lot about it, so I can skip that point, which means that we're now left with the policy arm, what we generally call structural reforms, or basically micro-type reforms. Now, before we go into a discussion of the micro-reforms, I'd like to talk about three big picture mantras about growth. Right. The first is growth and innovations. There's a general belief that we need to innovate to stimulate growth. And if that's true, and we look at this picture, this is some research that we're doing at the Melbourne Institute. We're looking at all the components that are classified under innovation, which includes R&D, trademarks, patents, improvements in business practices, and we sort of put them all together, get an index so that we can see the general pattern of innovation in Australia. Well, as you can see, it seems to be on a downward trend, which is fine, and perhaps that is the reason why we're having slow growth. However, if you look at the data more closely, you'll soon realize that innovation in Australia is not the big bang types. As an American economist said, Gordon said, the big bang radical innovations came out, and I like the way he classified them: steam, electricity, electronics. Easy way to remember them. And out of these big radical changes, there were small incremental innovations. Australia is very, very good at applied and translational innovation. And we've been extremely good in applying that, especially to our natural resource industries. So when we talk about growth and innovation, it's a wonderful mantra. It gets a lot of people very excited. To be realistic, we need to be talking about growth and productivity, or translational innovations, incremental innovations. The next general point I want to talk about is growth and jobs. Again, there's a belief that all we've got to do is grow, and if we grow, jobs will follow. That might be true for the US, and I was actually quite surprised when I did a scatter plots of rate of compare growth in Australia, in the US, with changes in employment and unemployment. You can definitely see the pattern there. If the US economy grows, jobs seems to follow, and unemployment seems to fall, except perhaps recently. But it's not the case for Australia. I was actually quite surprised to find that when you actually look at the data, you actually get a scatter plot. It's just not clear that just because we grow, we're going to create the jobs. And part of the reason why that doesn't follow is because the jobs the sector that was growing most in the last 10 to 15 years was in the mining sector. And the mining sector is not a labor-intensive sector. So for us to talk about growth and jobs, we need to ask the next question. where is it coming? The third point I want to make is about growth and inequality. There is, again, a certain general belief at the moment that if we grow, we will only create more inequality. There is some evidence that it is possible that if you grow, the rich could get richer, and that we could leave certain people behind. I think that that is just a case for being very careful about how we grow and where we grow and the way we structure our growth. If this is to happen, and the red lines, by the way, Australia, that sort of level of inequality, although it's deteriorated a little bit, is not ridiculous. But on the other hand, it is a message, an important message that we need to sort of pay attention to. Okay, so that leads me then to, given these 3 points in mind, that when we talk about innovation, we need to think about productivity. When we talk about jobs, we need to be worried about the sectors that we are talking about and where the growth is coming from. And thirdly, that when we talk about growth, we need to be aware of there are a class, we do not want to create a class of disadvantaged people in Australia. So bearing that in mind, I think that if we were to discuss growth and how we grow out of our current stagnant or slow growth stage, we should be talking about various types of micro reforms. And for me, it's sort of convenient to think about grouping them according to those 3 categories. First of all, we should think about markets. One of the ways to grow is if demand is growing. And if we can't grow demand ourselves because our population is sort of limited, we can always consider changes in the immigration policy. On the other hand, we could also think about creating new export markets. Are there demand for Australian-type products, especially in the growing, emerging economies? The next thing I think about is work incentives and participation. If we want growth, and we want growth for all, and everyone to benefit, we need to think about growth as an improvement in human capital. And that means having structures in place, reforms in place that improve the quality of education and training, healthcare, and housing. And the last point I would like to talk about is that when we talk about productivity, which we are going to talk about a lot later on, it's useful to remember that productivity is mainly driven by the companies, the enterprises. But we need to have a form of structure where, in some ways, the gains from productivity are shared equally between the workers, employees and employees. And the government can do something about that in terms of their investment in infrastructure, broadband, transport networks, because all this will help reduce costs, increase profits. Hopefully that means increased wages and more employment, and we'll all be happy. So in short, for me, the question is not that slow growth is inevitable. I think we are in for a period of slow growth. The question is not also that we can avoid it, but rather in the next few years, what we can sensibly do about sharing the limited pie. So we need to ensure that we remain productive. We need to ensure that there are equal opportunities for all. We need to ensure that we are spending, especially the government is spending money on infrastructure, broadband networks, things like that that will ensure that we have a strong base for building to have a great future. Thank you.
Issues. We've got until 7:15, so we've got 45 minutes. I want to take about 20 minutes to run through discussion and then open it up to questions. And I'll start with some of the questions that people were kind enough to send to us when they registered for the event. But let me just start with a question about why we're even talking about growth. This came up in some of those preliminary questions. We live on a finite planet. We're clearly running out of space around climate change. There are a number of other physical constraints. Is growth in GDP even the right measure? Why do we make such a big deal about it?
Well, I mean, I think for starters, one of the benefits of looking at GDP is that it is something that can be easily quantified and is not subjective. So I would love for there to be measures where we can include happiness, where we can include environmental costs, we can incorporate a lot of those things into our metrics, but there needs to be a framework and there needs to be an internationally recognised framework, so I guess the whole profession of economics can adjust to that new framework, if you like. I guess the other issue is that a lot of those other measures are a bit more subjective rather than objective, whereas a measure like real GDP is quite objective and quantifiable. So I think there are some challenges. It doesn't necessarily mean that we shouldn't try, though, to incorporate other things into our way of thinking. And I think the profession is evolving very slowly towards that.
Guai, any thoughts?
I tend to think there's growth and there's tremendous growth. If we're thinking about growth, and there's growth per capita. So if the population is growing at 5%, you like there to be GDP growth of 5%. So that's growth that just keeps us at the same standard of living. And sometimes I think we get distracted because we talk about growth and we don't actually think about growth relative to what is being used for. So if we want to maintain our standard of living, I'm afraid if population is going at 2%, at the minimum we have to talk about growth of 2%. However, we all desire to improve our standard of living. So if we want a little bit more, then we have to talk about the 2% plus a bit more.
And I guess you could add to that when you've got productivity growth,
Correct.
if the economy doesn't outpace population and productivity growth, then you're going to have declining employment.
Absolutely. Yes.
Yeah. And so all I would really add is that there's no question where you've got costs that are being imposed on other people. So, for example, you go to China, one measure of the cost of air pollution is that it's about equivalent to 10% of GDP when you look at the morbidity and mortality that's associated with that. And so there may be some relatively simple modifications without waiting for a full infrastructure that can give you a feeling for whether you're heading in the right direction. Because you can imagine in the worst case that you might be having a form of growth that is really detracting from welfare. Can I just move on then? What I thought perhaps we could do at a high level is first to try to draw the right lessons out of the stagnation that parts of the rest of the rich world have fallen into, then have a bit of an examination of Australia and then look at some policy issues. So Guai, if I could start with you. I mean, as a macroeconomist, did the financial crisis take you and your profession by surprise?
Oh, yes.
And if so, what lessons have you drawn from it?
Okay. I think that the development of financial derivatives and the way it was being priced, at the end of the day, was a key because a lot of people just did not understand that there was a lot of risk, there was a lot of supposedly on paper risk sharing around the world, but in actual fact, the people who were evaluating the risk really had no idea what they were doing. So in one sense, when that collapsed, perhaps the greatest shock to the profession was that a financial collapse could lead to real outcomes. A lot of times we've had collapses in the share market, Black Octobers. Share markets rise, collapses, we all worry about it, and then it's over and done with. Right? However, this one was prolonged, and I think that really shook the profession. Yeah.
So Larry Summers 3 years ago put forward the view that a concept that had been introduced in the wake of another financial crisis, 1929, and another prolonged recession, the Great Depression, could be relevant now. The view he put forward was that while the downturn might have started as a cyclical one, over time it seemed to develop into a syndrome where, at least for some of the economies, you had an excess desired savings rate compared to investment, leading to very low interest rates, and you had persistent low investment in the real economy, leading in turn to essentially a structural failure of the economy to renew itself and to generate growth. Is that a view, again, I'm speaking as a non-macroeconomist, is that a view that's got some traction inside the profession of macroeconomics, or is it really just a rhetorical device?
I'll go first. I think there is probably some truth to what Larry Summers is saying. I think, that we have seen lower rates of investment since the global financial crisis. But that perhaps is just a natural consequence of the magnitude of the decline that we saw and the uncertainty that many businesses and households are feeling in the aftermath. And it may also be that is occurring at a time when we're also seeing some very large demographic shifts and an ageing of the population as well, which is accentuating those factors. I'm not personally convinced that it's an intractable situation though, and it may just mean that we're seeing a much more prolonged cycle than we've seen in the past. So to some degree, I agree with his argument, but it might be exaggerating the story a little bit in my view.
Well, I'm going to go off on a slight tangent. I think when the crisis hit, the macroeconomists in Australia asked the key question: why didn't we have the collapse in Australia? Financial markets are integrated around the world. Australian banks borrow money from overseas. We understand derivatives. We have derivatives too. But what is it about the Australian financial system that somehow insulated it from the collapse? Right? So, yeah, the American system collapsed partly because there were a lot of tentacles around the world. There was lots and lots of linkages. So if one arm of the system collapsed, the rest collapsed. We're part of the system, but we didn't collapse. So the question that we asked was actually, what was it in the Australian financial system that actually prevented the collapse? Is it by some strange code that our four pillars of the four banks, that somehow the way they were structured protected our system?
You had some very good economists in some of those banks, I understand.
Yes. Yes.
Take all the credit.
I mean, the conventional wisdom seems to be that Australian banks did not own those toxic assets. And so while we were hit on our liability side, not on the asset side, B, obviously China came at the right time.
China came at the right time. And our flexible labour markets, that helped. And our government. We have to give our government a bit of credit.
So do you think that conventional view is about right?
That we were what?
Was the conventional view that we had those three factors that protected us about right? Yeah.
Yes, about right, yes.
Yeah. And so is there any relevance then? I mean, this is all now, 8 years ago, 7, 8 years ago. Why are we still talking about this? I mean, from my point of view, I look at the persistent very low interest rates. I worry about whether we've got policy room if there were another global crisis of some type or a major slowdown in China. And so to my mind, I feel that in a Rip Van Winkle sort of way, the Australian economy is now, finally with the resource investment coming off, potentially confronting some of the syndrome that the rest of the rich world faced 8 years ago. And we've sort of dodged that bullet, but are we now coming back into the firing line?
I think it is true to some degree that cyclical factors can become a little bit structural in nature. I think, in Australia, we've seen very high rates of capital investment in the mining sector, but not necessarily in the non-mining economy and not necessarily in infrastructure, and that will impede future rates of growth. You can also, there can also be a loss of skill in the labour market, which then impedes on future rates of growth as well. So that's something that's often called hysteresis in the labour market. When unemployment rates go up too high and there's long-term unemployment, then there's a loss of skills. So I think that is true to some degree, that the supply side of the Australian economy might not be growing as quickly as in the past, and that is something that the rest of the world is experiencing as well, which is overlaid with the ageing of the population. So I guess to some degree, I think that's the case.
Now, I guess the other side of the slowdown really feeds into a discussion about technology and growth, right? Whether there has been, Gui, as you put forward, a slowdown in the rate of innovation, or at least in the rate of innovation being realised in what firms are are really doing. And there seem to be two schools of thought. One of them is very optimistic, associated with people like Andrew McAfee, the fourth industrial revolution and the new machine age and so forth, quite bullish about the prospects that robotics and AI and so forth are going to transform our economies and lead to a big improvement in living standards. And then there's, you mentioned the Robert Gordon view, which is more pessimistic and says some combination of demographics and the fact that these really big waves from the mid-century just aren't being replicated, the next round of technology. Do you look at those two issues and come down more on the side of Gordon or more on the side of the optimists?
Well, I'm optimistic. I'm optimistic because I've lived long enough to sort of see big advances and big changes. And I'm constantly surprised at how creative people can be. And so in that sense, I'm optimistic. But I'm a cautious optimist. I think that we don't sit around and wait for the Big Bang. In the meanwhile, while we're waiting for some great things to happen, there are things that we can do to secure our future. And I think it would be great, wonderful, if the whole reform package will move in that direction. Yeah.
So can we turn then to some of those policy opportunities? So there'd be one view of what macroeconomists learnt from the great financial crisis and subsequent Great Recession, which would say, actually, you know, we had some more firepower in monetary policy than we had thought about for a long time. There'd been maybe 25 years where we just thought about short-run interest rates, and people rediscovered some tools like buying assets or setting forward guidance or thinking about nominal GDP rather than just the price level. And I guess one of the other sort of thoughts was, well, potentially activist fiscal policy, the tax and spend side, might have some more legs. So how are those debates playing out, both in the practitioner community and the theorist community?
I think as a practitioner, I think one thing that's become clear is that monetary policy does have its limits, and I think perhaps there's more acknowledgement that there has actually been an over-reliance on monetary policy. I guess there's some scepticism that quantitative easing has actually produce the benefits that it was intended to, particularly the pickup in investment in a lot of advanced economies that was hoped for. I mean, it has come through now in the US, but quite late in the cycle, and it has been largely absent from many other recoveries around the world, including Australia. There are also question marks over whether zero or negative interest rates have more costs than benefits. So, of course, low interest rates are negative for savers and, you know, for retirees, for instance, but also it does appear to be leading to some stress, not in Australia, but in parts of Europe where interest rates on lending products are now negative, then it does lead to some margin pressure for the banking sector in those places. And then there are counterintuitive things, like at the moment, for instance, there's a lot of pressure on companies to deliver high dividends. So if you look in Australia, just, you know, the speculation in the last couple of weeks as the major banks have been reporting their profits, a lot of the speculations around whether they're going to maintain their dividend or not. If companies are paying out very high dividends, they're not reinvesting in their business. So that might be another unintended consequence where you've got very low interest rates around the world. You've got a lot of people who are trying to search for that yield and don't have many options. So that is leading to some unintended consequences which may actually be stymieing investment. And the other thing that makes me just nervous is that it can cause excessive risk-taking behaviour like we saw in the lead up to the global financial crisis as well. I think in terms of fiscal policy though, I think most private sector economists in the Australian context at least still believe that we don't have a lot of flexibility because it's still quite a strong imperative to return the budget back to balance.
Great.
But it is about instruments and targets. So if you take interest rate, that's one instrument, what do you want it to achieve? Do you want it to achieve a level of inflation that everybody can live with? Do you want to use it to stimulate growth? Do you or reduce unemployment? And then fiscal policy, you've got the tax rates. What do you want to use the tax rate for? Do you want to use the tax rate to stimulate growth, or do you want to use the tax and transfer system to ensure that we have a decent welfare system and that income inequality is reasonable, is something that we can live with? So because we have to sort of, juggle instruments and targets, it is true that the profession came down to a point when we sort of said, look, let's keep monetary policy as the instrument to manage the economy, basically to even out the ups and downs. And let's keep fiscal policy as the instrument, particularly use the tax and transfer system to ensure that we are happy with our income inequality in Australia. That there are, we tax at a decent rate and we hand out welfare payments. And that worked for a long, long time until we hit the zero lower bound, as you rightly pointed out. And so, yes, there's certainly a rethinking about what we should use monetary policy for and what we should use fiscal policy for. But having said that, I think it would be more true to say that the profession is starting to think that it's silly to think that they are separate, that really monetary policy and fiscal policy should work together. And certainly, I'm not sure but there will be a time when if you look at old economics textbooks where that was paramount. And again, I suppose the profession has ups and downs and fads and fashions. And right now, it is a lot of research is sort of devoted to answering the question, how can monetary and fiscal policy work together?
Well, I've got lots of questions about monetary policy, but as a non-expert, I'm aware that if there's one part of economics that attracts cranks, it's probably that, and so I'll resist putting some of my own personal views forward, not to deter any cranks in the audience. So if I can move on then to just one final issue, which is to what extent, on the micro side of policy, to what extent policymakers need to do anything more than just try to set up the rules of the game and let private sector decision makers make their call about where to invest and how to behave. And I suppose that view is the conventional, if you like, neoclassical view. You try to build the infrastructure, help people get educated and set up the rules of the game. But there's a view that I think its proponents would say is a more nuanced one, that says every era of society has got a set of concrete challenges that need to be addressed. And whether I'm talking about people like Maria Mazzucato, who would say the successful state has always been entrepreneurial and has always been active in generating new ideas and innovations that the private sector then takes forward. Or again, it's now been 10 years since the Stern review, and Nick Stern would put the view very strongly, perhaps more strongly now than he would have 10 years ago, that the private sector needs some degree of confidence about the policy settings that are going to drive us to a low-carbon world and a low-carbon economy. And I think both of those authors would put the view that says, actually, an activist state, to some extent, is the right way to generate growth. And where you act, I think that the best summary would be Maria Mazzucato's point. She says growth doesn't just have a rate, it's got a direction as well. Do you think we need to be thinking from a policy perspective about finding what those directions are and communicating those out to the private sector? Or do you just say, look, it's all too complex, we've got to let the magic of the market figure those things out?
I think it's almost a combination of the two, if that even makes sense. We really need to have the right institutional frameworks in place. We need to have a taxation system that does encourage investment in productive assets, and there are changes that could be made on that front. But there is also a role for government, in my view, in reducing a lot of uncertainty for businesses in particular, but also for households. I mean, there are a lot of challenges that we need to navigate at the moment: ageing of the population, digital disruption, robotics, etc., which could have very disruptive effects on the way that businesses operate and structure their operations. And I think there's a role for government in helping business to, I guess, know about those challenges and look through those challenges as well. So, I mean, you can say, well, actually the government shouldn't interfere too much and let the private sector do its job, but in actual fact, I think there's an information asymmetry there, and people need assistance in that regard.
There's also economies of scale. There are certain activities that are best done by the government. And so long as they've got clear directions and we kind of all voted that that's the way we want to go, there are advantages to the government taking on the huge infrastructure jobs. Yeah.
Well, let me now just segue into questions from the floor, and if I can start with a couple of those canned questions we got at sign up. Ricky, can I ask you the tough question about Australia's household debt? Mm-hmm. Just coming back to Larry Summers, part of his secular stagnation thesis was that it was only the big rise in household gearing in the US in the early 2000s, during the Bush era, that sufficed to maintain aggregate demand at a level that was consistent with some degree of economic growth. So his view essentially was, if it weren't for the government attempting to blow bubbles, I'm being slightly blunt, that we would have had an earlier slide into stagnation. But obviously that creates its own risks. So where does Australia fit into that framework?
Well, I mean, for those in the audience that don't know, Australia has quite a high household debt to income ratio by international standards. It's at approximately 180% of GDP. However, it is important to note that just a high debt level in itself isn't necessarily a risk for the economy, because the serviceability of that debt is actually quite affordable, at least by Australian standards, because interest rates are so low. So that's the first point to make. I think, though, from here on in, though, the higher level of household debt does present a constraint on how fast we can grow household consumption, particularly because it will be more difficult to grow leverage without generating bubbles from here on in. I think that is the case. But I think that's just a return to a more normal state of affairs than perhaps what we saw through the 2000s as well. Because through the 2000s, the average household savings ratio was around zero, actually. So 0% of household disposable income. Currently, it's around 8% of household disposable income. But if you go back into the 1980s and 1990s, well, particularly the 1980s, then the household savings rate was at that 8% or so mark. So, I mean, perhaps the era of the 2000s was the unusual period. Perhaps that did lead to a build-up of leverage and some risk in the system. I don't think it will continue.
Guai?
I think what puzzles me about the household debt is why there isn't more evidence of deleveraging. Why are they borrowing more and more when they know that the house value is just going up, but it's probably likely to collapse eventually? So I am not sure about how to read those numbers. But like you also said, by itself, it's not something to worry about. People sort of draw attention to it and sort of get a bit anxious about it. But the issue has never been just the level of the debt. It's actually always, what is it used for? Yeah.
There's also some silver lining to that, and that, well, at least for borrowers, and that is that the RBA is very unlikely to raise interest rates in a large order of magnitude, because they are mindful of that high level of household debt as well.
In the US, they called that the Greenspan put.
Yes.
You'd always get an interest rate cut when you needed one, but it is hard at 1.5. Well, look, why don't we open it up to questions? And if people could just say your name, we are recording this event. It'll be preserved in some diamond hologram for eternity. Is that right, Susie? So choose your words carefully. And what I thought is we could pick 3 questions in a row. Normally what people say at this point when they're sitting where I am is, you mustn't make a speech, you've got to ask a question, but that seems a bit unfair coming from us. So if you want to make a very short comment, that's also fine, but do try to keep them brief. So, any takers? Couple down the side. Anybody down this side?
Thank you. David Lansley. I was wondering if I could really try and pin down the economists to be more specific about where they think the growth will come from, because I must admit I'm taking a view now that we're not going to see a mining boom like we've had, because if you take the fossil fuel component out of the Australian mining sector, it's just not going to provide the stimulus. So I think we can almost draw a line round about the end of that boom and say that's really going to be a watershed in Australian economic history. So given that, I think we're probably risking more of the slow growth trap than we are in terms of growth. But on the other hand, we've also been surprised by where growth can come from. And you think when tariffs were being unwound, education services came out of nowhere and surprised people with how strong they were. And I guess tourism at some stages too. So my question is, would people be brave and really try and pin down specific sectors that might surprise to fill in the gap that we're going to lose in the mining sector?
Yeah, terrific. So again, if we bunch up a few and then we'll try to process them. Don't be shy. One in the middle, and one right down the back too, so could perhaps go.
Graham Bull, you put out some charts early on, Ricky, which really showed how underemployment is growing. And it's looked to me like it's as bad as it was in the last time we had a recession, particularly for young people. So given that, I'm puzzled that we say that the labour market can't contribute much to increasing our potential growth rate. There's a big emphasis on the ageing population and the impact it's going to have. But how about significantly more emphasis on reducing underemployment and perhaps even shortening the amount of time people spend in education at the beginning of their careers? Because I think there's evidence that that's getting beyond the point of diminishing returns as well.
Thanks. Great question. We've got one more. Yeah, down the side there.
Gray, you mentioned about some big bangs event happening, and I just don't know in 21st century, internet access that or access to knowledge, I consider as another big bang event, which basically has moved the industrial society to a knowledge-based society. So all the instruments and everything that has been devised to measure the economic growth, which is dependent on the industrial kind of society, has to be reassessed to really or reinvented or redesigned to base everything on a knowledge-based society moving forward. That's my opinion. I just want to say what you have, your take on that. Thanks.
I'm finding these questions a bit hard. Do you think we should have any more after this? Sure. So the first one was around. What was the first one?
Growth.
Right.
Where's
right.
growth
okay,
coming
exactly.
from?
So given that we've got carbon constraints and
Yeah.
if you look at what we're exporting, essentially we're exporting carbon from the east coast, and China mixes that together with the iron ore we export from the west coast. So where do we go next for growth?
Well, I mean, that's the million-dollar question, isn't it? I think Australia's showing that it's got some natural advantage, as you already mentioned, in education exports. That's actually now our third largest export industry after iron ore and coal. And there's particularly rapid growth in student arrivals from some geographies like China. It's actually the services sectors of the economy that are really outperforming at the moment. You might have seen that in the chart that I showed of business conditions. And that's services sectors that provide services to households, but also those that provide services to business as well. I think there's increasingly a lot more export opportunities in that space, particularly given our close engagement with East Asia and emerging Asia, for things like architectural services, a whole lot of technical advice, even healthcare provision. There are a lot of opportunities, exports of Australian wine. I think Australia still, if we get the policy right, could still have some advantage in very high-end sophisticated manufacturing and biomedicals and that kind of thing as well. But, I guess one of the things is that you can't always predict which industries are going to pop up into the future. Maybe blockchain is going to revolutionise everything and there'll be a whole industry that emerges around blockchain. I don't know. But it's important that our economy is flexible enough to adjust to those shifts that are occurring at a global level, and that we retain the talent and the human capital that's necessary to allow those industries to flourish.
Yeah. I would echo whatever Ricky said. The last time I looked at the data, that's where I noticed where we were getting our growth. We were growing in, we're basically exporting services, accounting services and healthcare services. So I don't think I can add more than what she said, yeah.
And so, Ricky, I think the second question might have been directed to your observation that there might not be a huge amount of growth in labour input available, despite the fact that we do have quite a lot of underemployment. So how do you square those?
A lot of that comes down to, I guess, the sheer impact that the ageing of the population will have on the figures. So on our estimates, for instance, the demographic drag on the participation rate, which this is getting a little bit technical, will be approximately 0.2 percentage points a year, which is actually quite a big drop in the participation rate over time just from that effect. So while I would encourage policies that do try to address the issues of youth unemployment and underemployment, and I'm a very strong believer in supporting ways that we can improve female participation and participation of older workers as well. I guess the sheer maths means that it's very hard to offset that ageing effect. But for instance, female participation for Australia, overall our participation rate in the labour market, so people that are in work or looking for work in the labour market as a share of the total population, is actually above the OECD average. We're not near best practice, but it's above the OECD average. But for women of childbearing age between 25 and 39, we're below the OECD average. So there are things that we can do there to reduce the fact that there is a very high net marginal tax rate for women entering the workforce in those age cohorts. And, there are also other, measures that we can introduce around apprenticeships to support to youths trying to enter the labour market as well. So there's a whole lot of small reforms that need to take place, but within a coordinated approach towards trying to address this issue of lower rates of participation.
Great, and I would only add that the underemployment is small relative to those long-run trends, so that you can get a bit of a one-off from managing that, but losing 2 or 2.5% of the workforce every decade does overwhelm that. And then the final question was around measuring the knowledge economy.
And I believe you thought that was another big bang. So I think it is true there's more knowledge out there, but whether we've all become more knowledgeable is, for me, another question, right? Has it just been easier to access knowledge? I just have to, do a Google search and I find out lots of things. But I'm not sure I'm particularly smarter or I actually know more. And I think in the old days when I actually had to use pen and paper to actually solve something, I think I actually learned something. And there are times when I wonder whether my students actually learn anything because it's so easy for them to sort of get something off the web. However, I take your point that the way we measure GDP may not fully reflect the way we live our lives. And that, by the way, is an interesting sort of research project that a number of people are actually exploring, how to expand our definition of GDP so that it's just beyond measuring things that are traded to measuring other things that are more important in our life. Perhaps I could sort of leave it as that and sort of draw your attention to sort of literature that's of people who are actually trying to do a better job of measuring activity. Yeah.
Do you think that we're missing more of the value from, heaven forbid, Facebook than we did from I Love Lucy, the Saturday Evening Post, a Jane Austen novel? I mean, is the problem really getting worse, or is it just that, well, there's always stuff you don't measure?
Yeah,
and
that's right.
Yeah.
Absolutely. Yeah. I think that to the extent that you need to formulate policies, you need something concrete. You need benchmarking. And even if it's an imperfect measure, as long as we know what we're benchmarking and the sense in which it's imperfect, we can make adjustments. And so for better or worse, at this stage, GDP, as measured, is our way of keeping track of our performance. Yeah.
So we've got time for a few more questions. Now, typically men think they've got these great questions. And so who have we got? We've got one down the middle there, one on the side, one near the front. And that's probably just about it, I think.
Hi, Dennis Billich. Just wondering if you want to ponder any black swan events or things that could disrupt the economy in ways that haven't been put up on the slides.
Great. Down here. Yep, I think there's a question just down here in the fourth row. And then we'll get...
I'd just like to know your... my name's Greg Kemp. Your feelings about foreign direct investment, whether it's in property or farming or mining, how that impacts on us and what's the likelihood of that continuing, because I understand that's quite high relative to a lot of countries. And the impact of some of these closing down industries like car and some of the power stations and even the difficulties some of the agricultural companies are having, like Murray Goulburn, and whether you think we could ever have a Brexit type of situation, or even what we've got in America with Donald Trump, you know, appealing to the people who are losing jobs to either automation or going overseas.
Yeah. Yeah. Great. And if you could pass the mic back, because there was somebody in the row behind you, second from the end. We'll take those.
Hello, my name is Helen Millisser. My question relates to what we may do here to improve our own economic efficiency, our resource efficiency and our productive efficiency. So we know, for example, that we can't continue to emit carbon as we have. We know that 30% efficiency can be obtained by, or 30% reduction can be obtained by efficiency measures such as improved insulation, improved building efficiency, vehicle efficiency, and so forth. We also know that the linear system that we have in our economy is not sustainable. It is a one planet, and there is considerable advantage in things such as food organic recycling in order to produce better compost. We know that there is material scarcity, not just in precious metals, but in such things even as phosphate, which is going to have significant impact upon food production around the world. So my question goes to the heart of, what are the policy instruments and mechanisms that we should be putting in place for major reform to move from a high consumptive linear economy to a far more efficient circular economy that's fit for one planet? Thank you.
Great. There are three fascinating questions. So we don't have long. We're not going to be able to completely get all of our thoughts across, but the first one on black swans. Ricky, have you got a list of things you keep in the back of every presentation, if the audience can take it?
There's all sorts of those at the moment. I mean, there's the possible breakup of the Eurozone after Brexit. There's, of course, geopolitical risk around Donald Trump, for instance, becoming the US president, and we'll know about that tomorrow. But there's more broadly, there's been a rise in both extreme left and extreme right wing political parties. There's the impact of climate change and perhaps associated with that possible refugee crises. There's still a very high level of public sector debt, particularly across the advanced world. So in the event of a crisis, perhaps globally, a lot more so than in Australia, there's less ability to cope with that. I mean, the list goes on and on.
I'll take the next one of FDI. Yeah, there is a difference between a foreign direct investment and equity investment. If those rules are properly obeyed, then it's one thing to sort of accept foreign money to invest in a country and basically create jobs and growth here, well, as opposed to someone coming in taking over, basically taking ownership of the land or the plant or whatever. So I think we need to distinguish between when it's just straight money coming into the country and to be used for investment here to support growth and jobs here, as opposed to ownership. Yeah. The ones about jobs going overseas is interesting because the nature of jobs is such that there are certain jobs that are outsourced, right? And when I first heard that, accounting jobs are being outsourced to Philippines, it was horrifying. But, well, that's never a substitute for the personal relationship, that's one. But the other thing is also, perhaps it's time to be creative. If certain sort of jobs are no longer available because it's more efficiently done elsewhere, perhaps we as a nation need to think about what other things we can do. We're a clever nation. What other things we can do that will basically be our thing. And the case in point is the way we're exporting certain type of educational services. And dare I say it, consulting services as well. Yeah.
Terrific. And then the final question was around policy instruments to shift the basis of the economy to become sustainable. I suppose the conventional economic view there doesn't have to be totally at odds with a sustainable view of the world. So you'd say first you need to internalise costs so that people are making decisions that are imposing costs on other people or on future generations, bear those costs and change their behaviour. And that means some combination of a collective system for managing property rights or imposing private property rights and developing price mechanisms. But then I think there's a huge area where traditionally economists might say that regulation is going to be more costly than prices, but in fact, as a practical matter, heading in that direction can add value as well. But I'm just aware of time. I'm happy to have a further discussion on that point after the event. We've come right on to 7:15, which is our closing period. I've found the issues, Guai and Ricky, that you've raised really fascinating. Thank you so much for taking all of us through based on your expertise and experience. I hope the group has found it as illuminating as I have, and thanks so much for joining us.
Thank you.